what we're going to do today is we're going to do some transactions for Chapter 4, and that's pretty much going to be it for, that'll wrap up Chapter 4, okay? So I'll show you what other transactions we have that go on the multi-step income statement and how we do these transactions. So here is transportation costs. We just went over transportation costs and FOB shipping point and FOB destination point. So here we have Jason Inc. purchased $8,000 of merchandise inventory in cash, and also had $100 transportation costs because goods were shipped with terms of FOB shipping point. This FOB shipping point, does Jason owe the shipping costs? Yes, because he's the buyer. Everybody with me so far? So what's going to be our transaction? Let's start here. Is it cash or credit?
Cash.
It's cash transaction. Cash is what type of account? It's an asset. Did cash increase or decrease in the company? Decrease. They paid out cash. So how do we reflect a decrease in an asset? Credit. Good. So what did they pay out the cash for? Merchandise inventory. All right. Merchandise inventory is what type of account? An asset. Did we increase or decrease the merchandise inventory? How do we reflect an increase in merchandise inventory? Yeah. So we have cash, we have merchandise inventory. We're going to debit it for how much? How much are we crediting in cash for? $8,100. Fantastic. How much are we debiting merchandise inventory for? 8,000 or 8,100?
8,000 wouldn't do credit shipping expense.
Credit and then credit shipping expense. So you're saying it should look like this.
Yeah.
And you're saying no, it should look like this. Right? Why do you say that?
It should be the cost.
We're an accountant. It can't be the answer just because it's simple. Go ahead, what were you going to say?
It should be includes on cost, that cost or product up to sale.
So you're correct. It is 8,100 because just a quart, right? Just like he said, it is what you're putting in merchandise inventory is what it costs to sell, bring the product up for sale. The cost to bring product up to sell. The $100 shipping cost. Do you need that to bring product up to sale? Yes, because if you don't ship it to your business, you can't sell it. Everyone with me? So we have to include that into merchandise inventory to get the correct cost of goods. Everyone understand that? If you don't, please raise your hand. All right. So going on, so there's your transaction. Skip this. Oops. All right, so cost of merchandise purchase. This is just the upper level invoice minus discounts minus purchases, adding in transportation. It's just an itemized cost of how much it costs to get to purchase merchandise. And this is just the top part. This is of a computation of gross profit. It's just the top part of the multi-step income statement, right? The net sales minus the sales discount minus the returns and allowances. Again, net sales minus cost of goods sold, right? So this tells you how much profit are you making to produce product before we go into overhead. That makes sense? All the other stuff is overhead. Operating expenses, general administrative expenses, that's overhead. What you're looking at here is the company profitable just producing product? That's a yes or no. Oh, we'll point this out. Sales discounts and sales returns and allowances are contra revenue accounts. They're in the revenue section of the income statement. However, they are contra to the revenue, right? We subtract them. All right, so here's another question. Sales, or now what we're dealing with is selling goods. So we're selling goods. There's two methods in which we calculate the sale of goods. There's the periodic and there's perpetual. There's the periodic method and there's the perpetual method. I'm going to give you a visual example of both to kind of give you a feel on how it works. So we'll start with the perpetual method. Think of Walmart. And this is selling goods, right? So we're selling goods. So think of Walmart. When Walmart sells goods, when you buy a box of Tide from Walmart, right? It not only rings up the cost and the price of that good, but it also tells the people in the back, hey, one box of Tide has been sold, so later on you need to put that box back. Everybody with me? So it updates the inventory as well as does the selling price. That's perpetual. And that's what you're seeing here. When Diamond Store sells $25,000 of merchandise on account, the merchandise was carried in inventory at a cost of $18,000. You have two transactions in perpetual. One for the selling of product, one for the update inventory. So we're going to debit accounts receivable because they bought it on credit, and credit the sales for the sale, right? The price of the sale. Then we're going to update our inventory. So we're going to debit cost of goods sold and credit merchandise inventory for the cost of product. Is everyone with me? That's the perpetual method. Now, on the other side, there's the periodic method. So just think of a mom and pop store. Do you guys know what mom and pop stores are? I don't know, it's like an old word. It might be going out. That makes sense? I don't want to say mom and pop. And you're like, what the heck is that? Recently I said something to my son and he was like, my father wanted, the greatest thing my father said to my son was, you gotta have hustle. And you gotta hustle. And my son stopped my father and was like, what's hustle? I don't know what that is. And then my father was just, oh my God, the poor man was just taking it. He's like, they don't know what hustle is? I was like, they know what working hard is. They know being quick at your job, but no one's running around Sterling, Virginia like, yeah, I'm a hustler. Like, that's not happening. It's not this part of America. So, a mom and pop store, right? So think of a mom and pop store. What happens when you buy a good? Do they update their inventory list? No. You just buy a good and there's a sale, right? Later on, at the end of the month, what happens? You know, someone that works there will go and they'll count the Tide, and they'll say, yeah, we had 10 boxes of Tide. Now I'm counting them, and I only see 2, so we must have sold 8. And then they'll do the update of the inventory at the end of the period. So for this transaction, if we were doing periodic method, right? And this is another deal that changes the answer to what you would say. So this is perpetual. But if they made this statement, but they said, oh, they're doing periodic, your March 18 transaction would just be a debit to accounts receivable of $25,000 and a credit to sales of $25,000. That would be it. And then at the end of the month, let's say March 31st, they do an inventory count, and they would come back and say, oh, you know what? Let's say we sold $50,000 of tie. We sold $50,000 of tie, so we're gonna debit cost of goods sold $50,000 merchandise inventory for all the tie that was sold in that month, not just for that one transaction. Everyone with me? So that's the difference between the perpetual system and the periodic. The periodic, all we're gonna deal with when we make a sale is just a sale. And later on, we'll adjust the inventory. Under a perpetual system, we will make a transaction for the sale and a transaction for the inventory adjustment at that time, once it's sold. All right, so sales discounts. Let's say June 8th, Barton Company sold merchandise costing $3,500 for $6,000. Credit terms of 2 of 10, net 30. Let's prepare the journal entry. So this is perpetual. So we're going to debit accounts receivable, credit sales for $6,000 that's the sale or the price. And we're also going to make an adjustment for the merchandise inventory. So we're going to debit cost of goods sold and credit merchandise inventory for $3,500. That is our inventory adjustment. Everyone with me so far? Now let's talk about the discount. On June 17th, Barton Company received a check for $5,880, full payment for the June 8th sale. That means they paid within the discount period. That means they get their 2% discount. So now we need to take 2% of $6,000, which would be $120, right? 2% of $6,000 is $120. Please remember, and this is another time of me reminding you, right? When you take a percentage, you multiply by 0.02, not 2. You're doing it on your calculator. So you get $120. That is now remember, you only received $5,880 of cash. So that's a debit of $5,880 of cash, a debit to your sales discount of $120. That's the amount of discount you gave the client. And then you're going to credit their accounts receivable for $6,000. Does that make sense, scholars? All right. Next, we'll deal with sales returns and allowances. So remember, here we're selling a product. So Barton Company sold merchandise for $4,000, costing $4,000 for $7,500. On account meaning what? Credit. Fantastic. The credit terms are 2 of 10, net 30. When they sell it, we're going to debit the accounts receivable and credit the sales for $7,500. We're going to debit the cost of goods sold and credit merchandise inventory for $4,000. Is everyone with me? Now, June 14th, merchandise with sales price of $800 and cost of $470 was returned to Barton. The return is related to the June 12th sale. So when they return the product, we're going to debit sales returns and allowances and credit the accounts receivable for the $800. So remember, this is a contra revenue account. For the $800, that's the price. We need to also adjust the inventory. So we're going to debit the merchandise inventory and credit the cost of goods for $470. Basically what we're saying is we're putting this product back in the inventory to be resold at a later date. Everyone with me? Now, let's say on June 20th, Barton received the check for that June 12th transaction. What do we need to do? The first thing, when you deal with a sales, returns, and allowance, and then a discount, the first thing you do is subtract the return. Everyone with me? Subtract the return. So the total sale was $7,500. Subtract the $800 return, and we have $6,700. Then, if they're eligible for the discount, you take the 2% discount. So 2% of $6,750 is $134. Subtract that from $6,700, and you get $6,566. That's how much should be paid from the client. You should receive from the client. So we're going to debit cash, $6,566. We're going to debit sales discounts, $134, and we're going to credit the accounts receivable for $6,700. Everyone with the transaction? Hey, Brittany, you got a question? If you do, ask. When you're doing this, the first thing you need to do is subtract the return. Then you calculate the discount on the remainder. All right, I'm not going to really go over adjusting entries for the merchandiser, but this is just another showing of your multi-step. Oh no, this is just a trial balance, I'm sorry. And I'm going to show you the closing entries once again off the adjusting trial balance. Remember we did closing entries at the end of chapter 3 where we zeroed out the accounts. So I'm just going to show you this one more time. So what are we going to do? We're going to take the revenue, right, or the sales, and we're going to debit the sales. Here it's a credit. You see here, sales is a credit for $323,800. We're going to debit the sales, so then the sales account will be 0. We're going to credit those onto the income summary. Step 1. Step 2, we're going to credit the revenue. Step 2, we're going to credit the revenue. Credit the expenses. I said revenue twice too. Credit the expenses off and debit that onto the income summary. And as a result, the income summary will have all of the revenue and the expenses, so its total will be net income. After this step, we're going to take that net income and debit it off of the income summary and credit it onto the retained earnings. Right. That came right off the income summary. And then the final step, we're going to zero out the dividends. So we're going to debit the retained earnings for the amount of the dividend and credit the dividends off their account. Everything should be on the retained earnings. Here's our multi-step income statement, or a version of it. We've gone over this quite a bit, so there's no need for me to dwell on it. That's the single step income statement. I guess they got it here for you to wave goodbye to it one last time, because you won't see it anymore. And this is your class 5 balance sheet. It's class 5 because you should see it's in order of what? Liquidity. Fantastic. And here's your ratio.